and tax management program. We have a couple speakers who will get introduced here in a moment. Just wanted to do a few housekeeping things as we get started here. Just make sure your mic is muted and your video is turned off throughout. If you have any questions, just type them in the chat. We will get to as many as we can. Assuming we don't get flooded with them, we will try to get to all of them. And with that, I think we will move on to our introductions here. Sandra, if you want to introduce us agents, I will share my screen here.
Sandra, you're on mute.
Good evening. Welcome. As long as technology works, you're fine, right? As long as you remember to hit the unmute button. My name is Sandra Wick, and I am the crop production agent with the Post Rock Extension District. And we have several districts that have put together this program for you. And so we're going to introduce those, and Brett is going to share his screen, and so we can show you some pictures of our team that we have here for you. So as you know, it takes a team of people to put something together like this. So we have an awesome group of agents that we all have worked with here, and so I wanted to introduce them to you. First of all, we have Justine Henderson, and she is our livestock agent in the Central Kansas District, which covers a couple counties, and that would be Saline and Ottawa County. We also have Alicia Bohr, and she is one of the ag agents in the Cottonwood district, which includes Ellsworth and Barton County. We also have Clint Laughlin, and he is the director and the livestock agent in the Midway district, which covers Russell and Ellsworth County. And then, of course, Brett introduced himself as a livestock agent in the River Valley district. And like I said, I am the Post Rock district, which covers Osborne, Smith, Jewell, Lincoln, and Mitchell counties. So again, without all of us working together, this would not have happened. So I will turn the program over to the next agent, and they will introduce our first speaker.
As Sandra said, I'm Clint Laughlin. I am the livestock agent and the district director for Midway Extension District here in Russell and Ellsworth County. It's my pleasure to be a part of this program here this evening and bring you our first speaker on tonight's program schedule, Dr. Glynn Tonsor. Dr. Tonsor is part of K-State Research and Extension and a livestock agricultural economist. Dr. Tonsor currently focuses on a range of integrated research and extension activities with particular emphasis on the beef and pork industries. His broader interests cover aspects throughout the meat supply chain, ranging from production level supply issues to the end user consumer demand related issues. Again, thank you to Dr. Tonsor for joining us this evening, and I'll turn the reins over to him.
Excellent. Thank you for the introduction. Clinton, I'm looking at you. Will you give me a thumbs up that you hear me fine?
Yep, you're good.
Excellent. And you see my screen, hopefully fine? It's always good to hit pause and make sure we see them fine. All right, wonderful. Well, good evening, everybody. It is a pleasure to be with you. Thanks for signing on live. And for those of you that are listening to the recording later, I hope you find this valuable also. We're towards the end of a very unique year. And I think it's always good to hit pause and say what's going on in the markets we operate in. And I'm going to focus my remarks mainly on the feeder cattle side of things here tonight. So I'm going to give us a short outlook summary, and it's half a dozen slides. And I'm going to spend most of my time talking about some ways and a decision tool that's available on how to assess feeder cattle price risk and what options are available to manage that in the future. Some of you might be aware of those alternatives. It's always good to retool even if you are, and if you're not, this should be helpful. Those of you that have heard me give Outlook talks before know I like to use information from the Livestock Marketing Information Center. It's a group out in Denver, K-State subscribes to. They pull together a lot of information from USDA. They have their own forecasts and so forth. And what you're looking at here is their latest forecast. So these were dated the 9th of December. They update them roughly once a month. And in yellow, which is where I want to start, is the annual numbers from a supply perspective. And for 2020, we're going to slaughter about 2% less fed cattle than we did in 2019. Dressed weights are going to be up about 2.5%, and a net effect of basically no change on commercial beef production. Now, if I stop there in beef production, we had a lot of animals coming into 2020. This is not unique to cattle, and we even pulled forward production as it became clear we might have some production challenges. And the industry succeeded before COVID hit, and we had a bottleneck problem in actually boosting beef production in the first quarter. The second quarter, of course, was when the wheels fell off, so to speak, in our ability to convert animals into beef. All the commentary about COVID labor challenges and keeping plants running, that was happening largely in the second quarter, and we had an 11% decline. If you break it down for the next 2 quarters, we've gotten closer. We've been running kind of on par with the prior years since then. But first, this is a simple example of looking at annual averages can mask important difference. There's a big difference between the experience in the first quarter and the second quarter. Secondly, the other stuff that's like a homework assignment for you in the text box on this slide is what's happened to domestic consumption. So domestic consumption was up 5.5% in the first quarter compared to 2019. And take note, that was a smaller increase than the amount of beef we produced. How did that happen? We were exporting a lot of beef before the bottleneck happened. The second quarter, beef consumption fell down by about 8% per person, but that decline was less than what we had on the production side, which is 11%. Again, what happened? International trade adjusted and we exported a lot less. I'm highlighting that because an often overlooked role is our import and export decisions have a smoothing role that absorbs some of the shocks in the system, and consumers don't see as large of shocks because of that. And that was in spades here in 2020. Looking forward to 2021, we're looking at maybe a 0.5% decline in commercial slaughter, probably coming back on dress weights a little bit, and a net reduction of about 1% in terms of total beef being produced. And those trends are just going to be exacerbated, we think, looking out into 2022. So from a supply perspective, we have some hope for higher prices in 2021, 2022, because we're probably past the peak herd size story, and maybe we'll have some relief on fed cattle weights. What does that mean for prices? This is the same type of information, but instead of poundage and head count, now we're talking prices. The 5 market price you'll see here is down about 7% for the year. Again, that masks over important variation. The second quarter was the worst quarter for the fed cattle market when we compare it back to 2019. The yearling and calf markets are also off compared to last year, but importantly, I'll note they're not off nearly as much as most of us thought. Calf market in particular has rallied notably compared to what we were expecting around the end of April, May 1st. So a lot of folks were able to sell calves. If you're a fall weaner, sold them the last couple months at prices were much higher than we were expecting early in the pandemic. Looking forward out into 2021, there's reason for optimism that those prices are going to continue to improve. Some of that's just pure supply side. We have fewer cattle coming at us. The other is there's optimism that global economic activity is going to be stronger as we have kind of a bounce back globally, hopefully on the backside of coming out of the pandemic's worst, and that leads to higher protein demand. Specifically, if you look at the third quarter and fourth quarter of 2021, you'll see calf prices there between 162 and the mid 170s. So let's just say the 160s for simplicity here. That would be up $10 from what most people experienced here in 2020. 2022 is ongoing additional gains, mainly from a supply reduction perspective, thinking we'll have fewer calves to sell at that point in time. Now, as we transition into what does this mean for profitability, you got to think not just calf prices, but also your cost of operating. And to go even further, in a minute when we talk about ways to think about possibly protecting downward price risk on your calf herd or your yearlings that you may have retained, you need some context about what it costs you to operate. And there's a lot of different ways to go about that. This is maybe the simplest way to initiate that discussion. And it's simply to highlight what USDA says the cost of running a cow is over time. And even more narrowly, this is cash cost. So out-of-pocket cost includes pasturance and other things, but it would not include all your fixed cost and some unpaid labor and so forth. So it's not total cost. It'd be variable cost is a way to think through this. And the number I've highlighted there is $824. So they basically estimate it costs the quote unquote representative cow-calf producer $824 of cash cost in 2020 to run their herd. So let's translate that number a couple different ways. The first text box you'll see here I added is if those cash costs are $824, and for initial simplicity, cowboy math, if we want to label it that way, we ignore the cold cow revenue. So that's a side bonus if you like. We're going to ignore it because we're also ignoring fixed costs for a moment. What does that 824 imply about a cash cost break even? What do you need to get for a 6-weight calf in order to cover your cash cost? The number there is $137. So keep that one in mind. Conversely, what if we try to get at a total or more complete picture? So we take those cash costs of 824 and we approximate we have about $350 of fixed costs, non-cash. That gets us closer to $1,200 total. 1174 is the one you'll see here specifically. If we go further and we use a rough rule of thumb that over time, cold cow revenue represents about 15% of the revenue for a cow-calf operation, then when you put all that together, your projected total sale price to cover all your costs, once you account for all your revenue, is $166 per hundredweight. Now that went up, even though I'm now counting the cold cow revenue because of the notable increase in cost. So keep 166 in mind for the year 2020. That was kind of the break-even number that a representative operation would have been looking at. So what was the actual experience? This is LMIC information again, and it's a kind of a bar chart of profitability. The 2014, 2015 bars, we all remember they make these charts goofy. It was a really good time if you're a cow-calf producer, but their returns over cash cost. The numbers for 2019 were a loss of $51 per cow. Estimates for 2020 are right on par with that, a loss of $53. But please note I put in parentheses, this exercise does not account for changes in federal assistance. So the CFAP programs, there's 2 tranches of those and so forth. For a lot of producers, you could add 50 to $100 to the story, depending on exact situations and payment caps and so forth. But if we ignore that to be consistent with how this is typically derived, 2020 was on par to be the same as 2019. 2021 is looking more positive, about a $100 turnaround, so maybe a positive $57 per cow return over cash cost. So given that backdrop, and I'm purposely being quick because I don't want to make it a whole outlook talk, but I'm happy to answer questions in that space in the Q&A. Let's transition to forward thinking. How do we project future prices for our own operation? And how do we make decisions about possibly hedging or protecting that sales price? Well, first and foremost, if you're going to sell feeder cattle, you need to ask the question, how do I come up with a projected price? What resources are out there to give me a projected cash price for feeder cattle in a certain situation? And I'm going to encourage us to use the beefbasis.com resource. I've put a snapshot of my screen when I pulled this together here, but literally the website is beefbasis.com. It's pretty straightforward. It was built collaboration between K-State and some industry partners there in the state of Wyoming that run a large ranch there. Happy to talk more about how that works. But the synthesis would be is it pulls futures information from last night, coupled with historic basis information to give us projected prices. The scenario I did this weekend pulling this together, so all this will be dated as of the 13th, was what if I'm looking forward to next fall? So I'm a cow-calf operation that's actively planning ahead, and I sell in the fall, and I typically wean and sell at the same time. Well, let's just use the specific date of October 13th as the scenario, and I think I'm going to have 600-pound steers to sell. When you use this tool, you basically pull up what the historic basis relationships are, the current futures market is, to come up with a projection that is $161 per hundredweight. Even more narrowly, is just under $148 was the CME October feeder cattle contract, and a estimated or projected $13 basis. When you add those two together, that's how you get the $161 projected cash price. First and foremost, please note how that aligns with the 166 break even using 2020 numbers I showed. So that would put us on par with roughly a projected break even for that type of cost situation if somebody incurs this output price ultimately when we get out to October. The follow-up question, of course, is what are our alternatives? How can we compare those alternatives if we're interested in protecting that future activity where we're going to be selling a future commodity, in this case, a 6-weight steer next October in Salina? The answer to that is use the resources that are on agmanager.info and specifically an Excel decision tool. I'm guessing several of you that are on with us have heard Dr. Kevin Duvetter in person in the past, or have certainly heard his name. Kevin was a good friend and colleague of mine for several years, and he built lots of Excel decision tools. that you'll now find that are updated. And this is an example of one of those. So he built one of these several years ago, and I maintain and tweak it to try to keep it current. And again, this past weekend, I updated the situation. This specific tool is called KSU Feeder Cattle Risk Management Tool. The link to that is at the top. You can find it on our Ag Manager webpage if you go through the decision tools drop-down menus as well. And this is the first tab. There's 4 tabs in this spreadsheet. This first one just kind of gives us an overview of what the purpose of this resource is. And again, the main point of it is, it's to compare what our expected net selling price is for different ways of protecting feeder cattle price risk. That's the best way I know to summarize what this tool does. This is a snapshot of the second tab, and I fully recognize it's messy to show it on a screen here. I do this for a few different reasons. It's just to kind of snapshot it so you can compare it with my audio commentary later to understand what's going on. When you dive into the Excel tool, it usually makes more sense than just watching it right here. But while we're right here, while this is being recorded for future use, I want to highlight that the kind of the brighter blue text numbers you see here are user values that you can update. So I did this on December 14th. So at the top, you'll see current date. I typed in that day. You type in the number of head you're interested in considering protecting. I typed in 83. I did that on purpose because 83 head weighing 600 pounds corresponds really closely to the size of one futures contract, which is 50,000 pounds. We're going to change that 83 in a minute. And you walk down through this to when do I expect to sell? Remember, we're talking middle of October, what futures contract is relevant, so on and so forth. All these blue numbers you're looking at are they're inputs that can be updated to your situation. And there's a lot of drop down comments throughout this tool that guide you on how to get that information. Fast forward to this might be easier to follow than that full screen, is let's consider 4 alternatives for this specific situation. So again, let's say I have roughly a 100 head cow-calf operation. I anticipate selling something on the order of 83 steer calves. Actually, it'd be larger if you have 83 steer calves, just 83 calves in general here, next October. One is I could do LRP, so livestock risk protection. It's a USDA product that works kind of like insurance. One is you could take a position on the futures on the board, CME board. So one futures contract. That's why I pick an 83 head here for simple demonstration first. You could alternatively do a put option on that contract, which gives you the right to exercise something, but you're not locked in. Or you could take a cash strategy or the do nothing. I'll just take the market price at the time. So those are 4 alternatives that you could choose from. This tool is going to help us compare what we think those 4 alternatives look like today. At the time of doing this, the October CME feeder cattle contract was just below 148 bucks. That beef basis projection that I alluded to earlier was plus $13 for this Salina steer weighing 600 pounds in October, giving us that projected cash price of just below 161. The LRP coverage price I want to talk about is a lock-in at 140 bucks for board coverage that matches the contract. You obviously be selling lighter weights than that, and that would cost you a premium of $6.09 per hundredweight. At the same time, an October put option against the October feeder cattle contract with a strike price of 152 would cost you almost $12 per hundredweight. So those premiums, that $6 and $12, you can think of them as they're kind of akin to the premium you pay on your car insurance, your truck insurance, is you're paying for coverage. It's not free, that cost. And the specific premium you pay varies over time. It adjusts with the market, and it depends on how much coverage you buy. So the higher your coverage price, the higher the premium. The more volatile the markets, the higher your premium. Circling back to what comes out of that Excel tool. So I hope you found that last slide helpful, just kind of the notes about what was typed in there. This is an example of the results that come from this comparison. So at the top is a table, lots of numbers. And what you'll see there is those are projections for what we expect the net selling price to be. So what net selling price here is, it's at the end of the day, what's in my pocket. So I incur cost of protecting and I realize a payment at the end of the day, in this case, all the way out middle of October. What's the net outcome from that? That's what net selling price is referring to. And how does it change as the market adjusts between now and that point in time, which is October? Now, remember, the October contract was trading at about 148. So you'll see here in this table, we've got future prices that range from 125 all the way up to 165. So those futures prices of 145 or less would represent the situation of the feeder cattle market ending in October lower than it was when we make the assessment. Conversely, the 150 and above futures prices would be the case of the market rallying compared to when we did this past weekend. Along those lines, if the market improves and it ends up futures contract is 150 or higher, the cash strategy is actually the best. So the do nothing was best. The market rallied. You would have been better off not paying for price protection. And that's why when you look at this table, the cash strategy, there's a green box that says maximum price is the case for 150 and higher. For those of you who are following what basis is, you will see the cash column is exactly $13.09 higher than the futures column. That's because we have a projected basis value of $13.09. Conversely, if the market declines, so what if the market ends up, the market being the board, at 145 or less when we get to next October? Well, then doing the cash strategy would not have been good, but it still might have been better than some other strategies depending on how much the market fell. All we can really say with confidence is, in this situation, implementing a traditional futures hedge would have been best. So that's the red line that's on this chart that depicts those same numbers from above. And you can see it's basically flat. And it's flat because the 83 head I've picked very closely matches the size of the contract. And it's basically flat because the day you implement it, you're only exposed to basis risk, no longer contract price risk. And that mitigates your risk. And since I'm assuming here basis is actually the same as we project at $13.09, you get exactly what you expected. Now, let's make this a hair more complicated, a little more realistic. That was a bit of a summary academic example of how to use the tool. I still hope it helps you, but not everybody has 83 heads specifically. So what if instead you're interested in protecting 40 head? Whether that's because you have a smaller operation or you're going to retain more, or you just want to partially protect and don't want to, put your whole calf crop into this story, whatever the reasons are. If you're entertaining protection on 40 head, that corresponds with about half of the volume on a futures contract or a put contract. And that's where the role of LRP comes in, because you can pick the number of head you cover. So first I want you to highlight, I put a red text box around LRP and 40 head in the decision tool, because when you use it, you have to tell it how many head you want to cover in the LRP alternative that you're comparing. And I changed it from 83 to 40 to make this point. If you go further and look down at the visual chart that's down here, you will take note that we no longer have the nice, clean, flat red line through the futures hedge. It now looks weird, it looks goofy. Well, that's because you're half speculator, half hedger. You basically have 83 head worth of exposure on the futures market or with your put option, but yet you've only got 40 head that you're physically in the cash market interested in protecting. So that mismatch is what's at play here. And that's where things like the LRP alternative to protect your downward price risk is appealing, because you can specifically pick the number of head. It's not chunky. CME contracts are chunky and they're set numbers of weights, and it can be hard to perfectly match your herd size with them. To make that point even more clear, I kind of merged the last two slides. I recognize this is messy, but sometimes looking at both next to each other helps. And you can see the difference in these two charts. The one on the left is the first one I showed you. That's the case of 83 head. That's why we have the flat traditional example of the futures hedge gives us the exact price we expect because we don't have any basis shocks. On the right-hand side, we no longer have that because we have the mismatch between the number of head we're protecting and the fixed contract size with the CME products. I also want to highlight that the blue line and the green line are the same in these two charts. The green line is cash. So cash is the do nothing. I take what the market has at that point in time, and you with the same projected and expected selling price, whether you're selling 5 head or 100 head in this exercise. In reality, there's some small gains to having larger lots, but for this tool, it's basically the same. Cash strategy gives you the same thing. Similarly, the blue line, you'll see it's kinked, and that's for the LRP, the USDA product, and it is the same, whether we put 83 head in or 40 head, because you get to pick it. So your price per hundredweight doesn't change in that story. Conversely, the other approaches, the futures hedge, the put options, and the more complicated combinations that are on here, they're weird and kinked, and you could actually do better by the market tanking because you were actually a speculator if you took a position on the futures board, because you had twice as many animals protected on paper as you had in reality. Conversely, if the market really rallied, you could actually be hurt because your futures or put option, situation didn't align with your cash situation. So that's where understanding the volume you're protecting with the actual product you're enrolling in is really important. And I hope that visual comparison is intuitive for you. Another scenario we could talk through, and I'm not going to do it to the length we just did, is what about a winter programming? So, we're sitting here in the middle of December. There's been an awful lot of fall wean calves that are now in wintering programs, and there's a wide variety of those. They vary on the expected sales date and weight, of course. But let's just take one example. Say somebody currently owns, or they retain their own fall wean calf, and they plan to sell it in the middle of March weighing 800 pounds. Well, if you do the exact same exercise we just talked about using beefbasis.com, one of the things you will get from that is a projected Salina price for that scenario of $140 per hundredweight. That's taking the March futures contract at the time, a projected basis that's almost zero, merge that up, you get the expected cash price. Well, if you're sitting here today in December and you're contemplating what are my alternatives for protecting that $140 expected sales price in March, you could use the exact same tool, the exact same mechanisms we just did. You would back up, walk through that. You would plug in information tied to the March situation and your weights, the LRP premiums would be different and so forth. And you would come up with very similar looking charts where you could compare those expected net selling prices. I hope you recognize that the similarities are in both cases, you have a future sell of a commodity. In this case, it's feeder cattle. And we're exposed to market risk between the time of this assessment and when you're going to have that physical transaction where you exchange that commodity for cash, you actually sell it. If you're interested in exploring the price risk management options for feeder cattle, that is the point of this decision tool. My last two slides, they're broader comments, how to think about risk. First and foremost, we got to recognize that risk is two-sided. Sometimes we're rewarded for risk developments and sometimes we are harmed by risk developments. And 2020 is yet another wonderful example of that. So Kansas operations, who might be interested in the situations I just got done talking about, may have kept their own calves from the fall of 2019 and we're wintering them. And let's just say potentially we're looking at selling them in April. Well, those operations that did not have price protection in place as March of 2020 developed were fully exposed to the COVID situation. However, those that were hedged or protected against that avoided the bulk of the COVID-19 market decline that we saw in March and April. So that's an example of risk being two-sided, right? At the same time, that exact same operation probably didn't enter 2020 expecting the extent of federal payments that occurred. And depending upon what your decision on price protection was, you may have missed out on some federal payments that you didn't expect to be coming because of a past decision on how to protect your operation. That's not to say don't protect the downward price risk. I think we need to recognize those payments are probably not going to be an annual reoccurrence. But nonetheless, risk is two-sided. Things around us change, evolve, and I hope you appreciate those are two specific examples that have occurred here in 2020. With it, operating in a commodity market like producing feeder cattle comes with risk. It's necessary to absorb risk just to be in the industry. Some of those risks are viewed as opportunities, some are viewed as threats, some we can quantify. Price risk tends to be a little easier to quantify than some production risk and other risk to your operation. But regardless, I encourage you to, broadly speaking here for a moment, recognize that risk is two-sided. Sometimes we got to be exposed to it to do better. Sometimes we can reasonably protect ourselves. And by reasonable, that's a subjective term. You need to do the homework like we're talking about tonight to compare that. Your own operation costs are important in order to assess whether it's quote unquote smart to accept risk or if it's quote unquote smart to offset some of those risks, take some positions and focus your efforts elsewhere. And knowing what you're better at than the average operation, knowing your comparative advantage is important in that risk assessment process as well. So with that, this is my last slide. For those of you that don't know, on our Ag Manager page, each regular contributor kind of has its own homepage. This is the link to mine. You'll find a PDF of the slides I just walked through, and lots of similar resources are posted there as well. I hope you find them helpful. So I will throw it back to you guys.
All right. Me. And so if anybody has any questions again on anything Glynn talked about, or maybe even something he didn't hit on that you think he may have missed, please throw those up in the chat. I'll get it started here, Glenn. I've heard, producers say in the past, either you need to stick with selling your cattle on the cash basis all the time, or you need to hedge all the time. It's hard to outguess the market. Is there any truth to that?
I would agree with that general philosophy. So the order of advice I'd have is, and I was trying to be subtle here, but you got to know your cost to know your break even to assess if a price at any given time is attractive to explore. Everybody needs to do that. And you can only do that if you know your own cost. So that's kind of step one in this exercise. But most full out geeky academic statements and assessments of markets over time would come to that same conclusion, Brett, is trying to outguess the feeder cattle market is a fool's errand. I'm of the camp, same thing. I don't think I can outguess it. I don't think I can outguess the Dow and the stock market. I hold that opinion on lots of markets. Taking a regular position all the time and focusing on what you're good at tends to be a pretty good business strategy. So if you're not comfortable hedging your whole crop, that's understandable. Maybe regularly hedge half, or maybe, and this is a production risk, price risk strategy, is you could wait until your calf's on the ground. So we're past the bulk of the production risk, not all of it, but a fair amount of it, and then consider locking in the price on half your calf crop or 30 your calf crop or whatever you're comfortable with. But explore those kind of rules of thumb and basically regularly do them. Don't try to guess that, outguess the market. I think that's a fool's errand usually.
All right. And then there is a couple questions in the chat here, and I think the answer to the first one is yes, but might have to. I think you're more familiar with the Ag Manager website, Glenn. Is there a place on Ag Manager that gives a history of the basis for producers to study?
The answer is yes. The easiest version is there's charts that put it out by month for calves, yearlings, and fed cattle. That's there, and that's helpful. At the same time, I'm actually tempted to tell you, and I don't always do this, but go to the beefbasis.com resource. And when I say I don't always do this, because I think we have a lot of good stuff on Ag Manager, but if you go to Beef Basis, you can pick a specific market, and you can't do that under Ag Manager. So for example, if you're listening to this tonight and you're 5 miles from Salina, you can go, because Salina is your market in that example, you can go to beefbasis.com and download the historic Salina series. If instead you happen to live closer to a Nebraska market that's in Beef Basis database, I would encourage you to download that one and so forth. So you can tailor the history a little bit better if you go use the Beef Basis resource, because it has a long history of AMS data behind it that is sitting there, and I encourage you to use it. The stuff that's on Ag Manager is kind of statewide average for Kansas, and it's a good rule of thumb. It probably gets you in the right spot. But because I already kind of educated us on the appeal of fine-tune your own Beef Basis-based forecast, go there and download the historic information from there as well.
All right. Let's see here. What are the tools available to producers to help document their production costs?
So there are private versions out there, but the one I'll note is, and actually Robin Reed and I just updated these. So annually we put out what we call farm management guides. So there's a cow-calf one, there's a stocker, a background, or fed cattle. We do the same thing for swine and so forth. They basically are templates of how to go about thinking about cost. I describe them as a starting point for a producer to use to build their own budgets and monitor their own costs. So that's one tool that literally this week, Robin posted those updates. You can go download those and use them. KFMA, again, you can get to those links via Ag Manager. They put out what we call enterprise reports. So for tonight's purposes, I'll highlight the cow-calf sector. They put out basically benchmarking information from KFMA members, what the average feed cost per cow is, what the average labor cost per cow is, all that kind of information. I encourage you to make use of that. Those are both good starting points. So if you don't have any records, no information, start with those and then start taking note of how you're better or worse, whatever, than that, and tweak them. But that's a good starting point.
Very good. I don't see any other questions in the chat. I think we will move on to our next speaker.
Glenn,
go ahead, Clint.
Glenn, I did have one more.
Okay. Sure.
Where do you see 2020 ranking in the current cattle cycle? Do you see it being kind of a low, high, somewhere in between?
So yeah, I'll indirectly answer that. Is the January cattle inventory report comes out the end of January, and a lot of people are anxious to see what does that say? What's the herd size going to be? A lot of folks are predicting about a 1% decline in the number of beef cows compared to January of 2019. January of 2019 was a little more than 1% below the prior January. I think we're going to continue a small decline. Embedded in that, it's really important to recognize the average cow-calf producer is getting through 2020 better than we would have expected, in no small part because of federal government payments. So the downward pressure to quote unquote have to send the cows to town isn't the same. That's not the same as excitement about the future, but nonetheless, the forced, we did not have to liquidate the herd just to pay bills because federal payments were higher than we expected. So I think that reduces the downward pressure is what I'm trying to highlight for you. I think the herd will shrink a little bit. So it's middle. So if you make me pick between the two extremes you gave me, I don't think we're going to pull the herd down a lot though, maybe 1%. And all I add here, Brett, is I'm going to mute myself so that Clay can speak, but I'm not going to leave. So I'll hang around if more questions come up after Clay's done and so forth. I'm happy to help.
And just to add on to that, Glenn, 1% shrink was on par with projections from before the pandemic, correct?
Yeah, it was. And to drive that point home more, so Clinton, if you would have got me quoted on February and May, you would got very different answers from that. So back in February, I thought we were plateauing and there were some reasons to chase global demand and maybe we were kind of done shrinking almost. If you asked me on May 1st, I would have said, no, hell, we're going to pull the herd down because everybody hates this experience, right? And that was before the federal infusion. And frankly, the feeder cattle market ended better this fall than we were expected at that point in time also. So that story has improved a lot. Now with it, you got to have a high tolerance of heartburn. It's been a roller coaster and not everybody wants to do that. So I do think there's going to be some that exit, but nowhere near as much as we were thinking back in April and May.
All righty. Again, Glynn is going to stay on. If you have questions for him, please direct them in the chat. With that, I will let's see, Lish, introduce our next speaker here.
Good evening, everyone. I'm Alicia Bohr, and I'm here to introduce Clay Simons. He is a K-State Research and Extension Farm Management Extension Ag Economist. He works with other agriculture economists and cooperatively with farm families to provide members with production and financial management information for use in decision making. And as he told me earlier, also an otherwise nice guy. So with that, I will let Clay start up.
Okay, let me get my slide shared here.
That looks good.
Okay, I just got to get it moved over where I can see it now. Boom, boom, boom. And we'll just okay, can everybody see the slides now?
Yeah, you'll have to flip those on the display settings there, Clay.
Oh, I did. Did I get the wrong one over? Okay.
Yeah, if you just go over to the display settings, you can flip-flop them real quick on the top left.
Okay, there it is.
There you go. Just
there.
Swap them and
Okay,
you'll be good to go. There we go. We're good to
Thanks
go.
for the help. Okay, like Lish said, my name is Clay Simons. I am an economist with the Kansas Farm Management Association program. Myself and a team of 2 economists right now, we're in the process of hiring a 4th right now, work with farms and ranches. In the south central part of the state, we are a part of a group of about 25 economists that are working with producers in 6 associations statewide. And since we're about the middle of December, my topic for today is income tax planning in good times and bad. And some of these slides I am going to go through relatively quickly, like this one here. This first slide are just the marginal tax rates for taxable income for 2020 for single and married filing joint. And so the next slide are capital gains rates for single and married filing joint as well. One just side comment on capital gains. I know you always hear a lot of people say, gosh, I want to avoid capital gains. And yes, there are times to do it if you are able to do a like-kind exchange, if you are trading one piece of land for another where you can defer some capital gains. But in general, if you compare these 2 slides and the dollar figures that are in them, capital gains rates are quite a bit cheaper than ordinary rates. And so they're the cheapest tax you'll ever pay. So just always keep that in mind when you hear somebody say, oh, I've got to avoid those terrible capital gains. Also, if you are having a very, very high income year, you can also get some net investment income tax or additional Medicare tax. Those kick in on incomes, adjusted gross incomes of more than $250,000 if you're married filing joint. So how do we calculate federal income tax? Well, first, you're going to have to come up with your adjusted gross income. And that's going to be your non-business income, which is going to be wages, investment income such as dividends and income, dividends, interest, and capital gains, any rent or royalty income, plus your business income, which if you're a farmer is Schedule F, non-farm businesses are Schedule C. Those incomes are generally subject to self-employment tax. And then you would have your ordinary and capital gains on the sale of your business assets, which are not subject to self-employment. You're going to take that total income and you're going to reduce it by your contributions to health savings accounts, retirement fund contributions, health insurance cost, student loan interest, IRA contributions if they're traditional, and then half of the self-employment tax. And that's going to get you to adjusted gross income. The next step is calculating your taxable income, which is your adjusted gross less the standard deduction, which in the slides that I sent to Lish earlier, I did have the wrong numbers on here. The correct numbers are on here now. Single is $12,400. Married filing joint, $24,800. Or head of household is $18,650. So you are going to subtract the greater of the standard deduction or itemized deductions, and then you're going to take off the Section 199A deduction or the qualified business income deduction. That is the 20% deduction based on your business income, which it sounds simple, but it's a convoluted formula to come up with what a 20% deduction is. But that also comes off, and that leads you to your taxable income. And so then you're going to calculate your income tax based on the marginal rates, less any credits that are coming in, plus your self-employment tax. Now, self-employment tax would be payments into Social Security and Medicare. That is 14.13% of your self-employed income, which would be either Schedule C, Schedule F, or K1 payments that are subject to self-employment tax, generally out of a partnership or an LLC that's treated as a partnership. S corporation K1s are not subject to self-employment tax. Then you're going to add those together to get your tax. Then you're going to subtract from that any withholding from W-2s, any estimated tax payments that were made, and then certain refundable credits like the child tax credit or college credits. And so that in a nutshell is how taxes are calculated. Now, of course, you're going to have several, you need to have really good records to make for an accurate tax return. Plus, good records are a valuable management tool. In general, there are two accounting methods that you can use. Accrual, which most of the world has to use in far of their business, but farmers have the advantage of being able to be cash basis taxpayers, which gives farmers and ranchers a lot of flexibility in managing their income at the end of the year, and therefore managing taxes with ways other than just buying equipment and things like that that only accrual payers can use. Now, if you are looking for me to tell you how to avoid income tax, then I'm probably not the guy that you need to talk to. I firmly believe that taxes are something that you should manage. And you can sit there instead of having high income one year, low income, and just a zigzag going up and down all the time. Instead of doing that, you can use the advantages you have as a cash basis taxpayer to smooth those curves out, or to steal a phrase from my colleague Craig Althauser, you're wanting, when you're managing taxes, to cut off the tops and raise up the troughs. You know, maybe pay a little more than you normally would have in a low year, and maybe a little less than in a high year, and just try and even that curve out some. Now, there are 4 basic tax planning strategies that we're going to look at. First one is to minimize tax. The second one is to maximize income in any given bracket. You can also maximize your after-tax income, and you can also, one strategy that can be used is to spike income each 3rd or 4th year. We'll go through these one by one. First of all, minimizing taxes. And the goal when you're doing that, and I'll say right up front, this isn't my preferred method. You're wanting to keep that farm income as low as possible. You're always going to be pushing inventories forward, and you're always going to be pulling expenses back. But if you do this on a consistent basis, is your taxable income going to be too low? Your income should be high enough to cover any family living that is not covered by any non-farm income, such as off-farm employment by either you or your spouse. Any principal payments that are going to be made to your lenders on land and equipment, so any intermediate or long-term principal payments. If you're wanting to pay your debt off early and accelerate those debt payments in any way, then you have to have enough taxable income to cover that. If you're wanting to reinvest in your farm business, then you have to have the cash on hand to do that. And then also for some reserves for saving for a rainy day. The next strategy is to maximize the tax in any given bracket. And I spend a lot of time with my members working on this, and the target is to sit there and on a pretty consistent basis, try to hit the top of any of the given tax brackets that are on that first slide there. And so, if you're a relatively profitable producer and you're sitting there living in the 22% bracket, maybe a good strategy, especially this year where we've had an awful lot of government payments come in. We've got good prices for fall crop inventories that we're holding over until next year. Well, maybe we want to sit there and try and fill up that bracket as much as we can. And we can do that with the 12% bracket or the 24% bracket. But I'm talking about the 22% bracket, because when you fill that up, there is a maximum when you earn $137,700, you have paid the maximum into Social Security. And so from that point on, instead of paying the 15.3% self-employment tax, you're only paying 2.6%, or 2.45%, excuse me. And so that's a pretty dramatic savings by having a higher income in that bracket. But the other economic concept in maximizing your tax at a bracket is you are paying the same marginal cost for every extra dollar of income that you're taking that year. And so if you can fill that bracket up, you know your costs are going to be the same. And so you're going to keep the same amount of money after taxes when you fill that bracket before you go up to the next marginal rate. Now, and this is one thing that I've been seeing a lot with tax planning with my members this year. Sometimes if you've got some rising inventory values, especially over a 3 or 4 year period, if your inventory you're pushing into next year is growing, well, maybe you want to start moving up into a next higher bracket. If generally your strategy has been to live at the top of the 12% bracket, but your inventories are getting high enough that you really can't manage that well, you need to take some extra income, maybe you want to start going into the 22% bracket. The next concept is maximizing after-tax income, which is the goal here is to minimize your lowest effective tax rate. So you're going to take your total tax and divide it by your taxable income, and then try and make that percentage as low as you can. Now, this could result in a larger tax bill, but you're going to, for every dollar that you pay, have a lower effective tax rate. And that's the difference between marginal tax rates and effective tax rates when you're factoring in self-employment tax and all those other things. When you're doing that, you're going to try and hit the top of a bracket. Oh, I went backwards. The last strategy is to spike income tax every 4th year. I've actually had a couple of members that have tried this to varying degrees of success. The strategy for this is you're going to keep your income as low as you can for 3 years. You're going to build up inventory, and then you're going to sell that all in the 4th year. The advantages of doing this are you can save on self-employment tax during those low income years. You're going to spike it, and so you're going to hit that max pretty easy and have a lot of income that's taxed at a lower self-employment tax rate. Plus, you will be able to take advantage of income averaging, which is where you take your income from a higher year and move it back to the 3 previous years and fill up those lower tax brackets. There are some problems with that, though. It doesn't account for the time value of money. You've got the cost of carrying that inventory, whether it's in an elevator or it's in on-farm storage. You've got interest in storage you've got to pay, and so those carrying costs are real. If you need cash for family living, where's that going to come from? It's either going to come from off-farm labor or from the line of credit. And it could also have an impact on your Social Security benefit. If you're paying a low amount into Social Security over the years because of this strategy or a low tax strategy, then you could hurt yourself in benefits. And for those of you that always like to say, oh, I don't worry about Social Security because I'll never get that, they've been saying that since my dad was a young man, and I'm actually getting pretty close to Social Security age. And so I don't know that I quite buy that logic. So also, the big problem with this is you have imperfect knowledge of what your selling price is going to be down the road. I did have one member that did this, but the 4th year happened to be 2016. We remember what happened in 11 through 15, we had pretty high incomes, and then in 16, the bottom fell out. Well, he probably would have actually made more money selling some of that crop in previous years. Now, if you happen to hit the high year, and I've had people do that too, then this strategy can work very, very well, but it does have its risk. Okay, things to think about when you're planning for your taxes. First of all, don't separate it from your overall financial planning. Look at the long-term health of your business. What are your goals? If you're wanting to grow your net worth, pay off your debt, acquire more land, and just increase your asset value and net worth over time, you have to have taxable income. There are 4 ways in my mind that you can build wealth. The first one is to earn it, pay tax on it, and reinvest what you don't spend on living. That's the first way, and that's the solid way to grow wealth. The second way is to inherit it. Well, somebody has to volunteer to die to make that work, and we don't normally want that to happen to our loved ones. So that's not a good method. The third way would be to marry it. And if that's the only reason that you got married, then you're going to have a long and miserable life anyway. So that's not a good way to do it. The fourth way is to steal it. And there's a place down the road here in Hutchinson, down at the state prison, that is full of people that have tried that, and that doesn't work out so well either. The other thing when you're planning long term is you don't want to borrow from your future. I mean, don't deduct what you haven't paid for. You want to borrow to manage your tax, to hit those profit targets that you need to keep growing your business. Don't borrow just to avoid tax. And also, you can also use Section 179 and depreciation, but be careful when you're doing it on financed equipment and buildings, because you're going to have to make those payments. Excuse me. And if, depreciation isn't all bad. It's nice to have that expense when you are making those payments, because again, the only type of dollar that you can pay debt with to your lender is a dollar that you've paid tax on of profit. So, and so those are things just to keep in mind. I think it's very, very important, besides good records, is to use those good records if you're a cash basis taxpayer, to prepare an accrual income statement annually. Your taxable income should move in the same direction as your current inventories. So if your inventory values are consistently growing, well, your taxable income had better go up, so you can, and your tax liability should go up as well. But you can also use your inventories as a good predictor of next year's income. The other thing to keep in mind, is it wise to spend $100 to save 30 or 40% of it in taxes? That goes back to, y'all. I always like to tell folks when they say they want to buy a piece of equipment to save in taxes. You buy that piece of equipment because you need it, because it makes your operation more efficient. You need to replace some aging equipment. And then if you're doing it for those right reasons, then we can do whatever we need from a tax standpoint to help you out. But if you're buying it just to save on taxes, it's cheaper to pay tax, because the last time I looked, spending $40,000 in taxes was cheaper than spending $100,000 to save that $40,000 in taxes. Also, your lenders, and I saw Matt Linnemood's name over there. I remember him from my days back in the Flint Hills. Lenders like to see you generate income. It's a whole lot better than just relying on inflated balance sheets, because it indicates that you have the ability to repay those loans. If you're having a low income year, we'll talk just a little bit about net operating losses. Under the Tax Cuts and Jobs Act, we lost the ability to carry back net operating losses, except for farm losses. Other businesses lost it. Farms could keep it. You could carry it back 2 years, and then after that, you carried it forward indefinitely until it was used up. Non-farm business losses were only carried forward. Also, under the TCJA Act, you could only decrease taxable income by 80%, and you had to pay tax on the balance. And so some of that NOL was wasted unless it's totally consumed in that first carried year. Now, the CARES Act, it allows a 5-year net operating loss carryback on farm and non-farm net operating losses. So we've kind of gone back to the old rules for a couple of years under the CARES Act. It also suspends the 80% limit on net operating loss use. Now, the important thing to remember is that carrying back is the default position. You have to carry it back unless you elect out of it. So You always have to make that election if you want to just carry a net operating loss forward if you don't have the income in previous years to use that NOL up either 5 or 2 years ago. Another word of caution, net operating losses aren't hot. I mean, you want to avoid NOLs like the plague. For each year that you carry that net operating loss to, you're going to lose exemptions, deductions, some capital losses for that year. And so finding ways to increase income if you're facing net operating losses, I think is always a good idea. Again, avoid those net operating losses like the plague. There's years you can't help it. 2015 and 16, I had a lot of members that generated them, but you try to do what you can to avoid them. And so now the last little part of my talk is going to be on managing income. First of all, a little note about constructive receipt. You have received income when you receive the check and control the funds. So if you get a check in the mail on December 31st and you don't deposit it until after the first of the year, technically that is still 2020 income. It's not, are you using the funds? Do you have the ability to use the funds? And if that check's in your hand, you have the ability to use the funds. So if you're worried about getting some income late at the end of the year, you know, one strategy I will tell folks is to, if a neighbor owes you for a bunch of feed, they want the expense this year, but you want the income next year, have them throw the check in the mail to you on December 31st. Postmark it. You're not going to get it until after the first of the year. And so then you have a true constructive receipt argument that you received the funds after the first of the year. Deferred sales contracts. Those are pretty popular. You go down to your elevator and you sell 1,000 bushels of wheat, and then you delay payment on that until the start of the next year. You have under a proper deferred sales contract, you don't have the right to the funds until the stated payment day. You also stand the risk of loss. Those payments can't be guaranteed in any way. You're an unsecured creditor if the elevator goes broke, just like all the other unsecured creditor. And it has to be an agreement between a buyer and a seller. Livestock auction barns are not buyers. They are legally considered under the Packers and Stockyards Act a broker or an agent. I know there are auction barns that'll hold checks for you, but technically if you're ever audited, that's an issue that could probably come back to bite you at some point in time. If you're a cash basis taxpayer, like I said earlier, there are a lot of tools that you have to manage income, but you need to be doing a lot of this work in November, December, or like say now, between now and the end of the year, because you've got to do some pre-planning. So meet with your tax preparer ahead of time because you need to do some stuff. So as we go forward through these tools, PP means it's something that you need to pre-plan and do before the end of the year. AF is after the fact, and that is something that you can do after the first of the year. First of all, if you need to increase income, you've got a low income year. If you've got some inventory, you can go ahead and turn that into cash and do that. You can also elect out of installment sales. Say that you have $50,000 worth of deferred payment contracts. You can elect to tax that in the current year because it is considered an installment sale contract. You have to do it on a contract by contract basis, and you cannot receive the funds early. You just elect to tax it in the current year. And so I always recommend to my members that you do those deferred payment contracts in bite-sized chunks. You know, if you just have one $250,000 deferred payment contract, you either pull back all of that contract or none of it. And so if you have it in $10, $20, $50,000 bite-sized chunks, then you can go ahead and elect to pull back what income that you need. Also, if you have made the election to treat CCC loans as income, you can do that, but you have to do that before the end of the year. If it's in the elevator, you've got to have warehouse receipts. FSA has to go through some paperwork. And so that's a tool, especially when prices are lower, that folks can use. You can also, with some pre-planning in a low tax year, convert traditional IRAs to Roths. Essentially, if you've got negative income, you can convert your traditional IRAs to a Roth, elect to pay, essentially treat that as taxable income. And if your taxable income's negative, you're not going to pay anything on it. Or if you're at a much lower rate than you normally are, you'll pay a lower tax rate and then get the benefits of a Roth IRA as you go forward, which grow and come out tax-free. If you need to increase expense, you can use bonus depreciation in Section 179. The asset needs to be placed in service by December 31st. And by placed in service, I mean you need to be able to use it. It needs to be on your place by then. Just parking money and buying a piece of equipment at your equipment dealer, if it's not going to be delivered until March, technically that is not placed in service. Also, when you're, again, like I said earlier, if you are going to expense finance equipment, just do that with care, because you are going to have to make those principal payments in future years. I know there were some folks that I worked with that did a lot of that in 12, 13, and 14, and in 16 and 17, during those pretty tough years, they had a hard time coming up with those principal payments and had higher income than they normally would have had because they didn't have any depreciation expense to balance that out. A word of caution about equipment and building leases. The IRS can classify a purchase or a lease as a purchase if it has an easily identifiable interest component, if you build equity in that asset, and if you have the right to buy that asset for a very nominal fee at the end of the lease. Your residual needs to be something that's based on what the market value of that asset is. If you have a lease that the buyout fee at the end, the residual is $1, then it's really a loan. I mean, you can put lipstick on a pig and it's still a pig. So, if you have one of those things, just be very, very careful when you're leasing things. It's difficult to have leases that are actually qualified as leases in the eyes of the IRS. And a word of caution, don't rely on the word of the salesman or the person that's writing up the lease. I mean, you really need to have a lease scrutinized to make sure that it truly is a lease. Okay, if you need to increase expenses, you can prepay. Now, no more than 50% of your total expenses can be prepaid in a given year. Now, there are some ways around that if you just got a one-time going over that, but you should not be able to go out and do 100. You shouldn't be able to go out and prepay 100% of your expenses just to get your income down. They need to be made for a business purpose. Tax avoidance is not a business purpose. You have to actually purchase a commodity. You need to, instead of going down and just parking $50,000 at the co-op, you need to sit there and specify, I need to buy this many gallons of herbicide, this many tons of nitrogen, and then pay that. If you are just putting it on dealer financing at your local dealer, that does not qualify. If you're borrowing the money to do this, it needs to come from a qualified third-party lender. If you're a resale livestock person, resale livestock purchases are not expensed at the time of purchase. They are used as cost of goods sold at the time of sale. So buying cattle right at the end of the year that you're going to put some pounds on and sell 3 to 6 months down the road, that does not save you, that does not increase your expenses. And also, especially if you're under audit, IRS can come in and disallow this if it creates a very large negative checking account balance at the end of the year. So make sure you have your ducks in a row You've got your line of credit set up to where it's going over into your bank account so you can keep those cash outlays up. Also, if you need to increase expense, capital purchases can be expensed if you are electing into the de minimis safe harbor rule. And so you're making an election that anything that is under the safe harbor $2,500 or less is a de minimis repair. And this isn't 25 in total, it's $2,500 per invoice or item. So if you're working on one of these nice new planters and it's costing you $1,000 a row to get some repairs done on it, it's still repairs because each row is an item. Also, and that is something you can do after the fact. And then also charitable contributions, if you're going to do some of those, you can do those, but those take some pre-planning as well. Increasing expenses, you can do some retirement contributions. You can contribute to a traditional IRA or a SEP IRA, and you can do this after the fact. The plans can be established after the fact, and the contributions can be made after the fact, after 12/31. Now, one word of caution, especially on a SEP, if you are on a SEP and you have employees, they also must be included as participants in the SEP. And that counts for part-time employees as well as full for SEPs after they meet some years of service rules. You can also do a contribution to a simple or a self-employed 401k. The contributions can be made after the fact, but those plans, whether it's a simple or a self-directed 401k, need to be established before the end of the year. Especially with the self-directed 401k, you can have some higher contributions into it than you can with a SEP. Retirement plan contributions, they will increase your overall cash outlay, but they do decrease your tax liability. They don't affect self-employment tax. And remember, you can't discriminate against qualified employees. And then one way of looking at this, yes, they do increase your cash outlay, but the theory is that if it's a tax deductible employment account contribution, then you're making those contributions in higher tax rate years. And when you retire, your income should be lower and you're going to be paying a lower rate coming back out. If you need to decrease expense, you can slow down depreciation, and you can do that after the fact. You can elect to depreciate instead of using the 200% declining balance method, switch to straight line, or go to alternative depreciation system. You can also capitalize long life repair. You have that big planning repair that I talked about. If you have a low income year, instead of deducting that, you can elect to depreciate that over a 7-year time span and reduce your expenses, and again, use that to avoid net operating losses. Income averaging is a very effective tool, an important tool that's used only for farmers. You're going to fill the unused portion of brackets for the previous 3 years after a high income year. It does not affect self-employment tax, and tax software attempts to maximize it, but they don't always do that. So make sure you're using a tax preparer that is very familiar with agriculture. Just a quick word or two about tax preparers. First of all, ultimately, you're the person that's responsible for your return. You need to review it before you sign it. Ask questions. If you don't understand it, ask questions until you do understand it. There are some tax preparers that are just better than others. You know, does your preparer understand farm and ranch taxation? You know, some of them, they don't ask the right questions because it's a pretty specialized niche working with farms and ranch. Also, I would suggest that you never let a tax preparer make Section 179 decisions without your input, especially just to minimize tax, because like I said earlier, there are reasons to hold on to some depreciation. Also, many preparers complete returns based on only information you provide. And so if you fill out their worksheets and you forget to put something in there, it's not going to be used unless you provide them a complete set of records. So when you're going in to see your tax preparer, make sure you provide the value of, if you buy some land, make sure you put the value of buildings and improvements when that land is purchased. That's so you can get that on depreciation. Also, if it is land that you have not been farming, there's also a chance to take a residual fertility deduction as well. Breeding livestock sales need to be separate from market livestock sales. If your records just say cattle sold and you've got the raised cows mixed in with the calf sales, your tax preparer is never going to know that, and you're costing yourself money. Raised cows are taxed at capital gains rates, which if you're essentially in the 10 or 12% bracket are taxed at 0. If you're in the 22% bracket on up, they're taxed at 15%. So there are significant tax savings. Also, your cows that are, if they're purchased or your purchased bulls, the recapture depreciation isn't subject to self-employment tax. And that's a common mistake that I see on tax returns that are prepared by folks that aren't familiar with agriculture. Make sure that you have paperwork and you provide that paperwork on any capital asset purchases. And we need your preparer is going to need third-party finance details, and they're going to need equipment trade details. We don't have like-kind exchange on equipment anymore, and so that trade difference is actually taxed as a sale. And so your preparer does need to have that information, or there are going to be some errors on that return. Be sure you talk to your preparer about expansion plans, transition plans, retirement plans in any major business and life event, such as retirement, transition to the next generation. It's just important that they be kept in the loop with that. And I guess with that, there is my contact information. Appreciate the chance to visit with you in these brave new times that we have. And I'll turn it back to Lish or Brett.
Okay. Again, if you have any questions for Clay at this time, or if you want to go back to Glynn and ask him any questions, we will allow you to do that. Just type them into the chat and we will get to those. I will ask a question that maybe you may or may not be familiar with, Clay. Are there any tax credits for, I guess, carbon credits, anything in Kansas that would, if you're, you know what I'm talking about?
Yeah, nothing, there's nothing really out there right now. I mean, there's going to be stuff like that coming up in the future where there are going to be incentives for folks to store carbon or anything like that, but there's nothing out there really right now.
Okay. I knew they're obviously California's started that several years ago, and they get some tax breaks, but I didn't know if there was anything in Kansas or federally
Yes,
that would.
in fact, this is just kind of an interesting thing. They've got the new IGP has their new ethanol plant down in Colwich, outside of Wichita, and they have a certain process that they're using to make ethanol just for the California market, so they can take advantage of those credits. And they make California's ethanol different than they make everybody else's. It's kind of interesting.
Oh, we don't. Must be better then. I don't have anything in the chat right now. I will give everyone some time. In the meantime, Justine, do you want to talk a little bit about the wrap up here? Again, I don't want to rush anybody off, but if you got any questions, please pop those into the chat.
So, Brett, I'm going to jump in here. In 2020, it's important we keep it light and on point. I hope everybody took note of the lipstick on a pig is still a pig. I haven't heard that one in a while, so I'm going to say it again because it made me chuckle. So thanks for doing that, Clay.
Well, and the one thing I'll say on your thing, with the one point that I appreciated that you made, Glynn, was that when you're managing risk through a hedge, there is a cost to it if you're doing it right. That's just there's just always cost to managing risk, and I think that's very important for folks to remember that. You don't make money on crop insurance, and you shouldn't make money on hedge if the market goes against you. You're just protecting yourself.
Yep. If you do that regularly, you're just a speculator. So we'll leave it at that. Yep.
Okay. Justine, I will let you take it away. Again, if you got any questions, burning questions, please pop those into the chat.
All right. Well, while those questions kind of get brewed around in your brain, don't feel afraid to submit them on any of the platforms, whether it's YouTube or Facebook, Twitter, or even the Zoom. Go ahead and submit those and we'll get them answered. Take a moment here to talk about the survey that you see on your screen. It should be popping up in each one of your chats, no matter if you are Twitter, YouTube, or any of the other platforms. An agent will post that link to a survey that we would like to ask you to fill out. It's very short and extremely helpful to us as agents. Not only does it help us get an insight on kind of what you thought about the program tonight, but it helps us develop future educational programs that are useful to you. So if you could just take a few moments and fill that out, we would greatly appreciate it. On an additional note, I want to let you guys know that this program is being recorded and it will be posted on all of the agent websites, their individual extension websites, some of their YouTube channels, and the program video and the slides of the presenters are or will be posted on agmanager.com. So it will be on that website for you to view at a later date. So if you want to watch this program again, or for those of you that couldn't make it tonight, it will be available for you to access later on. So I don't know if there's any more questions in here.
I don't see any. Again, the Qualtrics survey is in the chat. If you could click on that, it's very short. It'd take you 2 minutes at the most to fill out. Would appreciate that. Yep. And we can just kind of hang on and see if there's any other questions. If there aren't any, I will let everyone know they are. I think we're wrapped up here, and I think you're free to go. If something comes up as everyone's logging off, we will certainly answer those questions.